Alright, hello everybody and welcome to this video. My name is Victor from the Gembox trading team, and today we are going to talk about trading systems using seasonality patterns. So the content is the following: what is seasonality, some seasonal factors and why they work, seasonal components and trading systems, and last a brief summary and my notes on seasonal trading systems. So let's start. First of all, what is seasonality? It's a periodic and predictable variation in a time series, as we can see over here in the average of 12 years in the temperature of a certain place. In this case, it's expressed on Fahrenheit, and we can extract that this is based on somewhere in the northern hemisphere. So a very common seasonal pattern, as the temperature can be extrapolated to trading. Seasonal patterns needs to last less than 1 year. Usually they will last a couple months at max, and this is kind of uncommon in retail trading. That means this isn't a hidden concept of trading, so to speak. But if I ask to, let's say, to 10 retail traders, maybe only 1 or 2 will be trading this type of strategies. So when we apply seasonality in trading, we are going to look forward for different approaches depending on the time frame. But in most cases, this is an average return. We are going to look for a defined trend in a certain time span. So we are always going to use data related to dates and maybe some fundamental reasons, that means macroeconomic factors. So why does it work? The reasons are not always known. That means some seasonal patterns may be caused by pure inefficiencies, pure market inefficiencies, and others may be related to, as I said, fundamental factors. So why does the price of soybeans, gold or oil go up at certain moments of the year or even certain moments of the day? So we are going to start with the cows. That means corn, oats, wheat and soybeans, or in other words, with the fundamental factors in grains. As we can see here, we have a chart of the seasonality of corn. This chart is provided by the CMA, the Chicago Mercantile Exchange, and we can see here a very interesting trend that starts in March and ends in July, and another one that starts very soon July and ends in December. Okay, this is based on the cycle of mostly every agricultural commodity. First of all, we have the plantation, collection and preparation, distribution and storage. That makes a classification based on new crops and old crops. When we have new crops, that means that we have already planted our soybeans and we are collecting them. We are flooding the market with new offers. And when we have already distributed our soybeans, the market doesn't have the same offer, but the demand is quite stable. So this is why the grains have such a defined seasonality. Excuse me. Alright, in gold this is quite similar. We have here a chart of the average monthly return in gold from the year 2000 up to 2017, and as we can see, we have some bullish months in January, February, August and September, and some bearish months on March and October. Alright, so what is this gold cycle or seasonality cycle based on? We have here a clear pattern in December and January that is based on gold production and demand. First of all, production decreases in January. I don't know the exact reason, but I suspect that is because in December, let's say that most of the mines are closed in the last 2 weeks of December. At least this is what happens at most mining companies, not all, but if you pick 3 mining reports at random from 3 different companies, chances are that both 3 reports have the same pattern, that is the lowest production of the year is in January. But in the same month the demand increases, both in December and January. Why demand increases here and supply is decreasing? Alright, this is due mostly hedge funds and mutual funds that will tend to rebalance their portfolio according to perceived risks for the year. Let's say that we have I don't know, a year with a very bad macroeconomic outlook. So if I'm a hedge fund manager, I will be buying a lot of gold to cover, first of all, the risks of my portfolio in terms of exposure, and also I will be buying treasury notes or European bonds to cover for this. So yeah, this is why in January gold tends to be so bullish, and we can even extrapolate this to February following the trend. And last, seasonal factors in oil. As we can see, we have 8 months of the year where this asset is bullish and 4 months that is bearish. But be aware here, we are entering in the danger zone, and this is why. So we are on the danger zone, and that means during a bullish seasonality period we have oil dropping more than an 84% according to the assets that you were looking for. If we are talking about the US AUDCHF ETF, that will be more than a 95%, and if we look to futures contracts, that the contract that were nearest to expiration and nearest to delivery, the prices were negative. So have our danger zone, and in a bullish seasonality we have the worst returns in the history of oil. So everything goes. Why did that happen? Okay, we need to have some common sense here. First of all, all averages are adjusted to volatility. Let's imagine a time series like this, minus 15%, 1%, 2, 3%, and minus 1%. 3 out of 5 months, and that means 60% of the months are bullish, but the total average will be negative. So not every month is a seasonal pattern when we are talking about long-term seasonal strategies. We are going to need a trading system that helps us to define risks, maybe to make some better entries based on these time spans, and we can even filter that according to the trend. So how to create a seasonal trading system? We have some phases here. We need to extract the seasonal components, we need to classify that, we need to study the drawbacks or inefficiency that we have found, and we are going to need to filter and improve trading systems according with this. We need a trading system, but before needing a trading system we are going to need to extract a seasonal pattern. Okay, so we have 2 phases there, the raw edge and the filtering phase. So about the seasonal components, we need to perform some studies using the optimizer. In this case I'm using MetaTrader 4 optimizer. Have over here the hour that I want to enter, minutes if I'm using a chart below 1 hour, closing in the name of, based on candles and candlesticks or periods. That means in this case I'm using a H1 chart. If my optimization close parameter is 1, that means that my trade will last only 1 hour. And the mode 1 for bullish, mode 2 for bearish, because remember, when we are talking about a seasonal pattern, we are talking just about one trend. Either it goes up or it goes down, but I can't find, at least using the seasonal component, a period that both trends goes. That's just a random walk. That's pure madness and randomness. So, seasonality in Forex, we have a set of factors here. Do we have fundamental reasons? What are the correlations? What time frame should I select? And how to search for inefficiencies. By the way, how to search for inefficiencies is also stated here, but in this case we are going to see some concrete examples. So, fundamental factors and correlations. First of all, we have central bank announcements, and those are usually made by day of the week or day of the month. For example, the non-farm payrolls that are always or most times released on the first Friday of each month. The ECB central bank and the ECB announcements, the European Central Bank, are usually made on Thursday. We have pairs related to commodities. What can extract, for example, for Australian dollar and Japanese yen in relation to gold, or Canadian dollar in relation to Texas crude oil, British pound in relation to Brent crude oil, or even the inverse correlation between Japanese yen and Swiss franc with stock indices. Alright, so we also have Risk-Premia concepts, just like the previous video. By the way, if you didn't watch that video, I will recommend it to watch, because some of the factors and things said in this previous video are involved here, such concepts such as Risk-Premia. And finally, we can classify this by trading session. That means, does the market behave in the same way in the Asian hours and in the American hours? That means liquidity concepts are different, market microstructure have changed over the last 20 years. So what can I extract here? This is an important clue, and can assure you that if you are going to seek for some patterns classifying by trading sessions, you are going to find something very interesting in some assets. I'm going to keep my mouth shut about that, so you have some homework to do here, but do that before this video, after this video ended. So, timeframes. This concept ranges from hourly candles up to monthly candles or candlesticks. That means we can check a seasonality based on certain hours, day of the week, day of the month, day of the year. We can use a lot of different concepts. We have a lot of different inefficiencies to go out there and find according to the type and the time frame of our time series that we are going to use. In this case, I'm going to center in pure short-term inefficiencies. So I'm going to classify the market to see the moments that have a defined trend. That means that if I trade from certain hours up to or during X periods, I'm going to have a bullish or a bearish trend. Alright? This is a study of market participants and market institutions. There is a good example about seasonality using both inefficiencies and fundamental data. And that is that in Congress days in the United States, you are going to each Congress day short sell the ES futures or the S&P 500 index. Why? Because it tends to go down, and this is already studied. That works quite good indeed. The time that we are going to use that fundamental data to find out pure inefficiencies to adapt, instead of shorting it the whole day, we are going to short the market during electronic trading hours. Alright, so this is a study of market participants. I don't even need to know that it's a Congress day. Maybe, I don't know what if the days that the Congress reunites is predefined day of the week, of the month, but I can just simply find that most Wednesdays market tends to go down. Okay, also pure inefficiencies may be based or maybe not in scandals. Some years ago we have a scandal on the British pound made by some banks, investment banks, and they rigged the trend doing a mean reversion about 5 p.m. London time. And if you go to optimize and to search in British pound based assets for that inefficiency, you are going to find it, but this inefficiency doesn't work anymore. So our first trading system, the seasonal Risk-Premia on gold. Okay, so what happens if I buy on a Friday and sell on a Monday? Okay, this one is very interesting because, as I said, this is a Risk-Premia based concept. This means I'm going to get paid like if I was an insurance company because I'm holding gold Saturday and Sunday. So I am assuming market risks, I'm assuming sell-offs due because I want to collect this premium each week. Okay, this is our raw edge. This starts from 2004 up to the day of today, 2020, 9 of September. And we can see that the bullish trend has stopped here in gold, but this inefficiency also works. This is our raw edge. This means we have more than 800 trades and I'm trading every day. And not every day, or better said, every week gold is bullish. I need to filter this to perform another classification. I have the time that I want to buy, but I don't have a filter based on the trend. Maybe this works better on an uptrend or maybe during a sell-off. That means, yesterday gold prices drop another 3%. Should I buy then, or should I buy when gold prices rose at 2%? I don't know. You need to filter this. This is just an approach and inefficiency. As you can see, this works the 56% of the time with a greater average profit rate than its counterparts on the losing trades, on the losing side. And the coup de grace, our intraday seasonality on AUDCHF, Australian dollar compared to Swiss franc. So we are going to short the market from 3 p.m. to 7 p.m. Darwin's time zone, and also IC market time zone, that is the UTC plus 2 time zone. And we have over here this raw wedge. This is an intraday one. I'm shorting the market every single day, no matter what the trend is, volatility is. I don't care about the factors right now. I just want to classify the market trend, and as I can see here, we have a very trend during this span of 4 hours. But once a seasonality is classified, we need to filter. Why would someone like to go short on the markets every day? Price have trends, and when this trend happens, I don't know, this seasonality works during bearish trends or works as a mean reversion strategy. That means in order to go short, the prices need to went up because I want to short at the highest price possible. And this is important because I don't want to be trading, in this case this is a backtest, about more than 2,000 trades. And the expected payoff, the expectancy of this system is very low. It's only a bit less than 1 pip and a half, 1 point and a half. So if I put this on the real market, the drawdown will be kind of big, kind of a great drawdown. Great not in the sense that it's a good one to trade, but in this case this is a big drawdown that is going to hurt our trading account. So this is our final system. In this case I have filtered it based on technical indicators using smart trading techniques that is called data mining. Data mining techniques, that is something that we do in the Genbox trading team. And as you can see now, the expected payoff instead of 1 pip and a half is more about 4 pips and a half, 4 points and a half. This is much better, and even if we change some ratios, we can have this being at 5 or 6 points. Alright, this is more kind of 5 than 4.5, since these trades are based on the Swiss franc, so maybe backtest is in euros. Okay, and as we can see, we have a 61% ratio of profitable trades, profit factor of 1.80. As you can see, we can compare here. Now our system looks much better. Alright, so we need to classify scenarios according to different seasonal concepts. If we are going to trade using the calendar, so to speak, then we need to filter our trades. And finally, as you can see, simple trading strategies can have greater results. So I hope you enjoyed this video. If that is correct, please hit the like button, subscribe to the channel, and leave a comment, and I will see you the next time. Bye bye.